Hey everybody, Matthew Cole with West Shore Mortgage in Sacramento. Today we're going to talk about interest rate and APR and how you know what the difference between the two of them are. I get a lot of calls from clients that want to know the difference between their APR and their interest rate and how they know the difference between the two and what each of the two of them mean. Obviously, your interest rate of your mortgage is going to be based off of what your payment is made of. So they're going to take your interest rate over time, over loan amount, and it'll give you your payment. It's going to be what creates your payment. When you always talk about interest rate and shopping around, that's kind of what you want to look at. But there's another term which is called annual percentage rate, or APR, which is also very important. More important on a refi than it is a purchase because you don't really control those numbers. But on a refi, you really want to know what the fees are in the loan. So your APR is going to be kind of the same math, but it's a little bit reversed. They're going to take your payment over time and your loan amount plus costs, and then that's going to equal the APR. So the math is a little bit backwards because you're adding in the closing costs and you already know what the interest rate is, so you're going to kind of reverse it a little bit, and then you're going to come up with what's called the APR. That's basically finance cost over time. So the APR is equally as important to interest rate, and the interest rate is equally as important to APR. So you want to kind of pay close attention to the two of them. Now, where this gets really confusing is on an FHA loan. An FHA loan is going to have an APR through the roof, where most conventional loans are going to be kind of right in line with each other. So for example, if you had a, say, 2.875 interest rate on a loan with very low closing costs, or just a typical closing costs, your APR should be right in the 2.9, maybe low 3s, upper 2.9 range. So they're going to be right in line with each other. You can always tell on a quote, like you see on these TV dummies, that are like, hey, get a 1.99 30-year fixed and a 2.8 APR. You're like, you don't really pay attention to the APR, you just see the rate, so you gotta look further down. How did you get this rate of 1.99 when nobody else is offering that? Well, if you look at the APR, that 2.8, it's because they're adding a ton of extra cost to buy the rate down. Now on an FHA loan, you can't think that way because there's an FHA funding fee that's added into the loan that's an actual cost. So that APR is always gonna be a lot higher than a normal conventional loan APR. But it's not because you're getting beat up on points or whatnot. It's because the funding fee is calculated as a fee and it gets added into the loan and financed over time. So that's why. So every FHA loan is gonna have a tremendously high APR. A VA loan will kind of have the same thing if the VA guarantee fee is in there as well. Every VA loan, unless you're a disabled vet and you have an exemption of the VA funding fee, you will have a higher APR as well with that included. So you gotta be mindful of your loan type, but on a conventional loan, you really have to pay attention because you're gonna see a lot of people trying to sneak in points to get your rate down and then have a super high APR. So all that is your cost added into your loan amount and financed over time. So if you have any questions and you feel that your lender might be pulling shade over your eyes and you're not being very upfront with what you're being quoted, give me a call. I'll break down like what's going on, what they're doing differently, and how we can look to save you money on your loan.